Good afternoon, everyone. Welcome to our Learn at Lunch webinar, Mastering the Housing Allowance and Clergy Taxation, hosted by Church Benefits Board. Please note as we begin that this session is being recorded and will be shared with you at the conclusion. We'll also stop the recording at the end and we'll open things up for a live Q&A session. We are delighted to be joined again today by our guest presenter, Amy Artiga. Amy is a longtime friend. She's a trusted partner of Church Benefits Board. She's a mom, wife, author, speaker. I have no idea how she does all these things. And she brings deep professional expertise as a certified financial planner and a certified kingdom advisor. Amy holds degrees in financial planning, in business, theology, and she serves as a faculty member in our CBB-sponsored financial wellness education events that we fondly call FWEEs. And Amy has done this with us since 2021, so she's been with us a very long time. I want to mention before we get into the webinar that our next FWEE is taking place in beautiful Louisville, Kentucky on April 19th through 21st. And you all who are here are welcome to join us. We're going to drop a link to register in the chat. And please make note that March 9th is the last day to register for the FWE in Kentucky. We're glad to have you all here. Amy, welcome. We're grateful for your partnership and we're excited to learn from you today.
Thank you so much for having me. Just as a quick disclaimer before I get started teaching everything, this is an educational session. This is not to be taken as personalized advice. If you do want personalized advice, then talk to a financial, tax, or legal professional, but this is just education in this setting. So we go to the next slide. When we talk about the housing allowance, it's really important to understand taxes first. So we're going to start talking about clergy taxation, which is very unique in the way it's set up and very unique. No one else is handled the way clergy is when it comes to the IRS. And to start, there are three main taxes that you pay based on your income. There's your income tax, and then there's Social Security and Medicare taxes. Next slide. So income taxes, just a little bit about the income taxes. As clergy, you pay income taxes as an employee. So you get a W-2 from your church and you pay like all the other employees who get a W-2 for their taxes. And there are tax brackets for the income taxes of 10%, 12%, 22%, 24%, 32%, 35%, and 37%. And so when you hear people talking about tax brackets, they're referring to income taxes. And then your income taxes can also be lowered based on different deductions and credits. There's a lot of different things that can lower your income taxes. And so income taxes for clergy, it's very similar to everyone else. It's pretty common how it's handled with other secular jobs. And then next slide. This is where things get really different for clergy and where it can be kind of hard to understand and wrap your mind around. And this is the Social Security and Medicare taxes. Some other names these taxes are known by are payroll taxes, SECA or SECA, and FICA. All of those different terms are talking about the same thing, which is the taxes you pay to fund Social Security and Medicare. And if you are clergy, then you pay these taxes as if you're self-employed. You are what the IRS calls dual status taxpayers, meaning you pay income taxes like a normal employee, but you pay these Social Security and Medicare taxes as if you're self-employed. And what that means is instead of having your employer withhold those taxes and pay half of them for you, at the end of the year when you file your tax return, you calculate those taxes on Schedule SE, and then you pay them that way. And I mentioned the employer paying half of them. So in a regular job that's not clergy, you only pay half of these taxes and your employer pays half. But for clergy and self-employed people, you pay both halves. It makes sense if you're self-employed because you are the employer and the employee, so you pay both halves. But for clergy, for some reason, I don't know why, I still want to know why, the IRS has you pay as if you're self-employed. And so what these taxes are is Social Security is a flat 12.4% of your income up to $184,500. And that's the number for 2026. Every year that number goes up a little bit. And so you pay a total of 12.4% of your income on all of your income up until that that amount. And then amounts above that, if you have higher income, you don't pay any Social Security taxes at all. And so this is different from the income taxes where there were different tax brackets depending on how much money you have. Social Security is the same tax rate for everyone up to that cap. And then Medicare is similar in that it's a flat 2.9%, except for it's on all of your income. There's no cap. So whether you make $50,000 or $5 million, you're paying 2.9%. However, there's an additional tax that's, it was a recent addition, and that's a 0.9% tax on any income you have over 200,000. And that doesn't matter if you're married or single, that's just an extra tax. And so this is the one where it's a little bit more complicated because you're paying Social Security up to a limit, and then you're paying Medicare on everything. But those are what you calculate at the end of the year on your Schedule SE for taxes. And if you've worked a secular job, you'll see that your employer withholds these taxes. For clergy, employers actually aren't allowed to withhold the taxes. It's not allowed. And so you have to pay as if you're self-employed. And when it comes to actually paying the taxes, there are kind of two different ways you can approach it. And waiting until April to pay is not one of those. Here in the US, we have what they call a pay-as-you-go tax system, meaning you pay throughout the year. And if you wait until April to pay your taxes, then you'll have to pay underpayment penalties because the IRS doesn't want to wait till the end of the year for their taxes. They need it now because they are spending it now for sure. And so you have to pay as you go. And if your employer is withholding it, then you're automatically paying in. But as clergy, your employer isn't withholding it. So what do? You have two different options. The first is paying quarterly estimated taxes. And this is what self-employed people do as well. On a quarterly basis, and the IRS has certain dates you're supposed to pay throughout the year. There's 4 of them because it's quarterly. You have to pay estimated taxes. And so your combined Social Security and Medicare taxes are about 15%. And so you can make quarterly estimated payments of about 15% of your clergy income, and that should have you covered. It can kind of be a pain, though, to pay these quarterly payments. I mean, it's nice with modern technology. You can just get onto the IRS website and make your payments electronically, but you still have to get onto the IRS website and make the payment. So one thing a lot of pastors do is they'll actually withhold extra income taxes because churches can't withhold Social Security and Medicare taxes, but they can withhold income taxes. So a lot of pastors will just increase their income tax withholding to cover that 15%. And so that way the church is withholding enough in taxes. It's just labeled income tax. But that doesn't really matter because when you file your tax return in the spring, like you should be doing right now, the way it works is you calculate your income taxes and you calculate your Social Security and Medicare taxes, and then you add them all together for your final tax bill. So if you're paying taxes throughout the year that are labeled income tax, then it's okay because at the end of the year, it's all lumped together and that can cover your Social Security and Medicare taxes. So in summary, for clergy taxation, you pay income taxes as if you're employed. You pay Social Security and Medicare taxes as if you're self-employed. And to pay those taxes, you can either make quarterly payments to the IRS, or you can just withhold enough in income taxes to cover that. And you can have your church withhold those income taxes, or if you have an outside job or a spouse with an outside job, then they can even withhold those. It's all lumped together, you and your spouse, income taxes and Social Security and Medicare taxes, it's all lumped together at the end. So as long as you're paying enough in throughout the year, no matter how it's labeled, then you should be fine. And so that's my broad overview of clergy taxation that's important to understand as we get into one of the greatest tax benefits that clergy have, which is the ministerial housing allowance. And what this is in the IRS, the Internal Revenue Code, the tax law, it says that clergy can provide a home income tax free. And it really is that simple and unclear. And so the IRS has created a lot of rules to try to explain what it means to provide a home and what is actually income tax free. And so that's what we're going to talk about next. So next slide here. So this is hard to see, but you will get the slides afterwards. And this is actually something I have, I didn't mention, but I actually have a book that I wrote on the housing allowance. I didn't mean to write a book. I sat down to write a free download for my website, and there was just so much information it turned into a book, and this is in the book as well. It's also available on my Pastor's Wallet blog for free, this download, but you have it here in the slides as well. And this just breaks down whose responsibility different things are between the church and the minister. And that's always a big question. It's like, well, who's responsible? Who does what? So for the housing allowance, this is how it works. We have two columns here. We have the pastor and the church. And you as a minister, it's your responsibility to request the housing allowance. And how you do that is you calculate what you expect your housing costs to be. And if you follow a budget and have good records of your spending, then this should be easy for you. If you're like a lot of people and you don't do that, then it might be a little bit harder. I actually have a calculator on my blog where you can type in the numbers, but there are also a lot of different, forms out there that are easy to just, look over, okay, what's included and add in the numbers. And so what you want to do is you want to calculate what you expect your housing costs to be. And then I usually recommend increasing it by about 10% because there's no penalty for requesting too much housing allowance. If you request, let's say $25,000, and then you only end up using $23,000, that extra $2,000 at the end of the year, you'll just add it back to your taxable income, which is actually very easy to do. There's no penalty. Whereas if you only request $20,000, but your actual expenses end up being $23,000, then you just have to pay taxes on the extra $3,000. So as you're calculating your anticipated expenses, I recommend increasing that by about 10% when you make your request, just to cover things that, things come up. Your water heater breaks, it needs to be replaced. Your kid breaks their bed when they have 5 of their friends jumping on it. You need to buy a new bed. You never know what's going to come up. Your fence blows over. I hope that doesn't happen to any of you. But, things come up. So I always encourage people to just increase it by about 10% just to cover the what ifs. And then if you don't spend that much, it's really easy to add it to your taxable income at the end of the year. So once you've calculated your anticipated expenses, then you'll request the housing allowance from your church and say, this is how much of my salary I want to be housing allowance. And then your church has to officially designate the housing allowance. And there isn't one way to do that. It just basically has to be in writing. So some people write a letter saying, your housing allowance is going to be this amount. Sometimes it's just a budget line, in the budget, or meeting minutes say, in the meeting we discussed and we are designating this much as a housing allowance. So it can be handled many different ways. The big thing is it just needs to be done in writing, and it needs to be done before the housing allowance is actually paid out. You can't look back for the housing allowance. It's only looking forward. So you can't get a new roof and then tell your church, hey, I need more housing allowance because I just got a new roof. Because once you've already paid for it, you can't go back and pay for it with housing allowance money that has been paid out after it. So you request it from your church designates it. And then throughout the year, you need to track your housing expenses. Nowadays, with all the electronic payments, it makes it a lot easier. But if you're paying for things with cash, keep record of that so you know how much you're actually spending. And then the church's responsibility is to actually pay you. Isn't it lovely that you're getting paid for your ministry? And so they're paying you your salary and they're paying you your housing allowance. And on your pay stub, there'll be 2 separate lines because the housing allowance isn't subject to income tax. And so they're just paying you and you're spending the money and keeping track of it. And then at the end of the year, your church is only responsible for telling you how much they paid you in housing allowance. So they can do that as a letter, or sometimes they'll have it on the form W-2 in box 14. That's an informational form, and it'll say, housing allowance, $23,000. Or they'll give you a letter saying, this is what we paid you. And then it's your job to prepare your tax return, to calculate if you had any excess housing allowance, add that into your taxable income, calculate your Social Security and Medicare taxes, and do all of that. So that's all your job. Often I hear from people that are on the church side and work for the church saying, oh, our pastor requested this, but that doesn't seem reasonable. We want to see what they're spending it on, or we're afraid they're, spending it on different things. It's not the church's responsibility to police the pastor and make sure they're doing things correctly. That's between the pastor and the IRS. So don't worry, pay your pastor what they ask for. And if they're doing something wrong, that's between them and the IRS, and the IRS will go after them. A lot of people are afraid that their church will get into trouble, but your church won't get into trouble. It'll just be your pastor. but hopefully you're all doing it right, especially after this webinar, then you'll know how to do it right, which is great. And so just a quick thing on the taxation there. So your housing allowance is exempt from income taxes, but not Social Security and Medicare taxes. So you're not going to pay the, 10%, 12%, those income taxes on it, but you do have to add back in your housing allowance, or if you live in a parsonage, the value of your parsonage when you calculate your Social Security and Medicare taxes on Schedule SE. So it's important to remember a lot of people kind of forget to pay Social Security, Medicare taxes on their housing allowance, but you're supposed to, and also the value of a parsonage. That one's more often omitted because you never actually see that money, you're just living in it. And so, but you need to know the value of that and add it back in for Schedule SE to pay those taxes. Okay, next slide. This is a big one, housing allowance limitations. So you can't just claim everything in the world as a housing allowance. The IRS has put limits on it. And there's 4 different things here that are the limits. And one thing that's really important is to recognize that you're allowed to claim the lesser of these 4. It's not a menu where you just pick one and go for it. It's whatever one is the least amount. And so you have to actually calculate all these and go with the least amount. I've heard a lot of people have gotten bad advice, even from CPAs and tax preparers saying, oh, just claim the fair market rental value. I've heard them say, oh, well, my tax preparer said that once I pay off my mortgage to just claim the fair market rental value. And that's not actually allowed unless that is the lowest of these 4 numbers. So your housing allowance has to be the lowest of the fair market rental value, your actual expenses, the amount officially designated in advance, or 100% of your compensation. And so the next question everyone asks is, how do I figure out the fair market rental value? And we have a slide for that. So next slide. So there isn't one set way to calculate the fair market rental value, but the IRS just wants to see that you're using a reasonable method and being consistent over time. So one thing, the first one, which might be the easiest if you have a real estate agent in your church, or it might be hard if you don't know a real estate agent, is just consulting a local real estate agent. Now, the housing allowance, the value of your home isn't the empty house like a lot of the listings for rentals are. It's your house with all of your furnishings and your utilities as well. And so you can ask a local real estate agent and say, okay, if I were to rent my house as is, completely furnished, how much could I charge? How much would a stranger pay me for this? And that's your fair market rental value. Another way is to look up a rent estimate online, somewhere like Zillow, or there's probably other websites, and that'll say, oh, you could rent this house for this much. And so you take that number, but that's for an empty house. And then you can add in the cost of renting your furnishings, or you can take that number and add in a percentage premium based on local furnished rentals. And if you have no idea what I just said, that's okay. I will explain it. So if you go to rent a house, you can rent empty houses, which is what most people do, or you can rent furnished houses. I just moved across the country last year and I had no idea where I was going. And so for a couple of months, I actually rented a furnished house because I didn't want to have to pack and unpack multiple times and I wasn't sure where I wanted to buy a house. And renting a furnished house costs more because they give you all the furniture. You don't have to bring your own. And so you can look in your local market and compare and say, okay, an empty house rents for this much. How much more are people paying for a furnished house? In whatever that percentage is, you can apply it to the rental estimate for the house you're living in and say, okay, this is what it would rent empty according to the internet. And so I'm going to add this percentage for a furnished rental. And so that's what that third bullet point is, that whole percent premium based on local furnished rentals. It's just saying how much more do people pay for rentals that are furnished in my local area, and then adding that amount. The fourth one there is the capitalization rate, and that's a little bit more complicated. It's basically if a business person were buying this to rent it out, what percentage of the value of the home would they require in rent in order to make it worthwhile for them? And then you just look at the value of your home and use that percentage because that's what a business person would use to rent it out. I do have an article on my blog that goes into that in more detail, but probably one of the top 3 is a better option for you, but that's there. And then last but not least, don't forget utilities. because your utilities are included in your housing allowance. So it's not just your house with your furnishings, but it's all the utilities that are being paid for as well. So that's calculating the fair market rental value. We'll go to the next slide. And then the next one we have on here is your actual eligible expenses. And this is where you have to be tracking your expenses throughout the year so you know what you actually spent. And if you spent more than the fair market rental value, then you can't claim all those expenses because you're limited by the fair market rental value. If you spend less, then you can only claim that because you can only claim what you spend. The next one is the amount officially designated in advance. And this is why I said it needs to be designated in advance, because your church will say, we are paying you $25,000 this year. And if that's what the church has designated, then you can't claim $30,000 because they've only claimed $25,000. And then the last one there is 100% of your ministerial compensation. And that may sound a little confusing because how can your church pay you more than they pay you? But this is a common question for bivocational ministers. You know, maybe you get $10,000 from your church and you have a job where you earn $60,000. And they say, well, can't I take a housing allowance from the job that they actually have more money to pay me since I actually have $20,000 worth of expenses? But a housing allowance can only come from ministerial income. And so it's only what your church pays you. So if you have $25,000 worth of housing expenses, but your church only pays you $10,000, then you can only claim $10,000 as a housing allowance. So those are the limitations. And it's really important to understand those because there's a lot of confusion about these. A lot of people think you just pick one number, but really it's supposed to be the lowest number out of those four. Next slide. So
I have a question.
We're going to do a Q&A.
Hey, Jim.
At the end.
Yeah.
Jim, we're recording now, so we would like to do the Q&A at the end. If you can hold that question, please.
Certainly. No problem.
Thank you.
Thanks. So one of the big things everyone asks me is, okay, where's the list of eligible expenses? Because it makes sense. It's a good question. It's to be expected. You want to know what you can claim, right? But the thing is, there's not a very specific list out there because the tax law just says, you know, you can get this income tax free to provide a home. And that's really as specific as they are in the actual text of the tax law. And so the IRS has given some guidelines, but there are a lot of things that aren't written down specifically. And so this is a list of eligible expenses. And you, like I said, you'll get these slides so you can go through it. But it's the typical things you'd think of, like your mortgage and rent and, you know, insurance and fees, anything related to your house, your property taxes. But it's also your furnishings and not just your necessary furnishings like a bed, but even what some people would call unnecessary, like decor, decorations, you know, the fake plant here or the vase. Those things are also eligible expenses. Bedspreads, sheets, towels, all of these things are eligible expenses. And we'll go to the next one, and this is ineligible expenses. And this is the shorter list. And the reason we even have this list is because these things have come out of tax court cases. Because like I said, there's not a detailed list of everything. And so there are a lot of things that are actually just judgment calls where you have to say, is this eligible? I don't know. It's not clear. I'm going to claim it. And the way we got this list is someone claimed something and the IRS said, no, you can't claim that. And then the minister said, no, I want to claim that. Let's go to court. And so they go to tax court and then the judge decides. So that's why we have a very short list of ineligible expenses, because it requires a court case to actually get it. But the things that are specifically ineligible based on tax court cases are groceries. That is necessary for life, but not necessary for a house, your food. Servants, which is probably a really old case because we don't really use that terminology anymore. Maid service, another, you know, old-fashioned terminology. So your cleaning lady doesn't count. A lot of people say, how come my yard guy counts and not my cleaning lady? It's like, well, tax court case. That's all. I don't know. And then personal items, personal gifts, paper products like plates and napkins. We had a whole discussion in one of our live events about toilet paper. And I personally think toilet paper is necessary for a home. And so I would feel very comfortable claiming it, but not paper plates, but your plates that you wash every day and reuse, those are eligible. But then personal toiletries, personal clothing, cell phone service, Now, a landline that's attached to your home is eligible for the housing allowance, but a cell phone is not because you carry it with you everywhere you go. And in the same way, a desktop computer is eligible, but a laptop is not. And I've had people want to argue with me about this, and I just like to say, I do not make the rules. I just try to explain them in a way that people will understand. So the IRS made the rules. I'm just trying to communicate them to you. But basically, this is the list of ineligible expenses that exists. And the next slide here is, these are the questions I ask myself when someone says, well, how about this? Is this eligible? And the first question I ask myself is, would I provide this in a vacation rental? So if I had an Airbnb that I was renting out, I would have linens, I would have beds, I would have decorations, I would have electricity, but I wouldn't have deodorant and personal toiletries. I wouldn't have food for the people. Like I know some Airbnbs have like granola bars, but not food. So like those personal items that people bring with them, you wouldn't have. And so that's one way of kind of thinking like, okay, is this an eligible housing expense or is this a personal item? And then the second one, which is kind of, you know, the bottom line is, could I argue this in tax court? So is it something where it's like, yeah, I think I could, you know, make it work, but you're not confident enough in it where you'd be like, go before a judge and say, no, I believe this is right because of this. But so if you're not sure, then don't do it. But if you're confident and you say, no, I think this is right and I would be able to argue it, then go ahead and claim it. Hopefully you won't get audited and we'll never know for sure, but go ahead and claim it. And so those are just kind of two questions I ask myself. One thing is I've had people ask me, well, what about a storage unit? I'm going to be between houses as I change jobs or as I retire, and I'm going to put all my stuff into storage. But because if it's a storage unit that's like, you know, the big ones where everyone has their stuff there that's off your property, it's not eligible. If you have a shed on your property, then that's eligible. So it has to be on the property itself. It can't be off the property. So that's just one little thing. And then also is it required for a home? I had someone email me once and say, hey, we live in Alaska, you know, out in the middle of nowhere. And in order to clear our driveway from the house to the road, we have to have a small tractor. Is that an eligible housing allowance expense? For me, I live in a suburb, that would not be eligible at all because I have a nice driveway I can go. But thinking about it, if you can't live in that house without that tractor, then I would say that's an eligible expense. And so I told them I would claim it if I were you, but then again, it's still your judgment call. So that's just kind of how I approach the things that you're not really sure about and trying to figure out if it's eligible or not. Okay, next slide. So here's just some other things to know. I just threw them all in one slide because they're not huge topics. The first one is this tax exemption, it's exempt from income tax. It can't overlap with a deduction for business use of your home. So if you also have a business where, you know, you use an office for an outside business and you take a deduction for that office, then the housing allowance can't cover that office. Or if you're renting out your basement for Airbnb or something, your housing allowance can't cover any part of your home that's being used to generate income. What you would do in that situation is figure out what percentage of your home that income generating part is, the office or the basement rental, and then you can only claim that percent that's not being used for income as your housing allowance. So things like electricity, if it's furniture, you know what room the furniture is in, so you know if it's for your house or your business. But something like electricity or, you know, the sewer, you don't know, you can't separate that. So just do it based on percentages of square footage of your house. The next one is a cash out refinance or a home equity line of credit is only eligible when it's used for home expenses. I've had people tell me that they were advised once they paid off their mortgage to take out, to refinance and borrow a bunch of money so that they can have another mortgage in order to keep using the housing allowance. But that's only eligible if you take out the money and use it on your house. So if you take a bunch of equity out of your house and you use it to send your kids to college, that is not eligible for the housing allowance. So you would have to look at what percentage of your debt is based on the house and what percentage is based on, you know, the college education, and only claim the percentage based on your house. So you can't game the system by taking on more debt and pulling equity out of your house. That's not allowed. It's only eligible for home expenses. And then another one is you can only claim a housing allowance on one home at a time. And this came out of a court case where a minister, I think it was in 1999, he was claiming a big, a big housing allowance on his residence, and then like 100,000 a year on his lake house as well. And the IRS didn't like that at all. So you can only live in one place at a time. So you can only claim one place at a time. I have had pastors who tell me, they say, I actually pastor like 3 small rural churches. And so I spend 3 days out of the week in this house and then 4 days out of the week in this house. And in a situation like that, you can either just claim one house and only use the housing allowance on that house, or you can do it proportionally and say, okay, 3/7 of my housing allowance is this house and 4/7 is this house. But it all has to add up to only one home. And then another one, the IRS does not limit timing to request the allowance. There are churches and organizations who say you can only request it at the beginning of the year. That's what you get for the whole year and you can't change it. But that is an organizational thing. The IRS itself doesn't do that. So if you need to change it in July because you realize your housing expenses are totally different, as far as the IRS is concerned, you're welcome to do that. If your church doesn't like it, then bake them some brownies and say please and try to be nice and try to get them to let you do it. But the IRS itself doesn't limit that. Another one, the housing allowance, it's a federal law. So it's exempt from federal income taxes, but most states also exempt it. The only one I know of that doesn't is Pennsylvania. They have some very unique tax rules there. So as long as you don't live in Pennsylvania, then you don't have to pay state taxes either on your housing allowance. And then one thing that's actually very helpful for a lot of ministers is that the housing allowance is not included as income for the FAFSA. That was a change that just happened a couple years ago when they revamped the whole FAFSA. They tried to make it simple, and so they cut out the part where you had to add back in your housing allowance. So that was a huge benefit for those in ministry. And then it's also not included as income for Medicaid and premium tax credits, which are the Obamacare subsidies. And so in that way, your housing allowance can really help you with those government programs. But there is one thing where the housing allowance can hurt you, and that's because it can limit the child tax credit. Because your child tax credit is based on a percentage of your income, totally eliminating your income or lowering it a lot with the housing allowance can actually reduce your child tax credit. And so if you have low income and a lot of kids, then I recommend running the numbers to see. Some people, it actually doesn't even make sense to claim a housing allowance because they get more in the child tax credit than they would save by claiming a housing allowance. And it's okay to do that. The housing allowance is something that's available to you, but it's not required. If you decide not to claim a housing allowance, it's not like you're doing anything wrong and the government's going to come after you. Sometimes people feel like they're obligated to claim this much, but there are a lot of tax benefits that people don't take advantage of, and that's okay. There's nothing wrong with that. So just figure out what works best for you within the law. Don't evade taxes, but figuring out what works best as far as how much housing allowance to claim for the child tax credit is fine. Now, next slide. Housing allowance and retirement. There's just a couple points I want to make about this. The first one is probably the most important, and that's to claim a housing allowance in retirement, your funds have to stay in your church 403(b)(9) plan. What happens is when you start getting older and you start getting more gray hair, all of a sudden, all these financial advisors realize that you exist and they want to be your friend and they want to help you roll your 403(b) into an IRA when you retire. And for a lot of people, that's actually good advice. But if you're in ministry, don't do it. Please don't do it, because only the money while it's in your church 403(b)(9) plan, it's only while it's in there that it's eligible for the housing allowance. If you roll it into an IRA, it will not be eligible anymore. And I've gotten emails from people that say, hey, I retired last year and this guy in my church helped me roll my 403(b) into an IRA. And now I just learned that I could claim a housing allowance in retirement. What can I do? And my answer is find a way to get the money back into a 403(b). Sometimes it means, oh, I'm going to get a job for a little bit at the church to roll the money back in, or it's just you take the loss. But in order to claim an income tax-free housing allowance in retirement, your funds have to stay in that church plan. And then aside from that, all of the same rules apply. So it has to be designated in advance, and it has to be the lesser of those 4 different amounts. So all of the things we just talked about still apply in retirement. You'll just be taking the money from your 403(b) rather than your paycheck. And then the last one on here is I learned about this as I was researching the housing allowance. The IRS actually has what they call a no ruling list, and it's a list of topics that they refuse to give any kind of guidance on. And so they say, you can ask them about it and they'll say, sorry, we're not talking about that. And the housing allowance in retirement is one of those things. So it's on the no ruling list because it's understudy and it's been there for over 30 years. So I wouldn't hold my breath about it coming off of that list. Basically, the IRS has probably said, well, that's complicated. We don't want to deal with that. We have enough work as it is. And so you can actually, if you Google, you'll find there is a letter from some Congress, I think it was a Congresswoman, she was trying to help one of her constituents, and the IRS basically just said, sorry, we don't talk about that. And so if you want clarity on the housing allowance in retirement, I'm sorry, they don't do that. So that's just on their no ruling list. They won't provide those answers. And now Jenny's going to talk about your specific retirement plan and claiming a housing allowance.
Great. Thank you, Amy. So just for those of you who are current participants with Church Benefits Board and maybe approaching retirement or currently in retirement, we wanted to just outline the process for requesting a housing allowance withdrawal from your CBB retirement account. So the first step, you can either call Empower and request, we have a specific housing allowance withdrawal form that you would need to complete. You can get this from, we have a unique 866 number for our faith-based plan that you can call to get that form, or you can also log into your Empower account and access this form under the plan forms page. Our team is also happy to help you find or locate that form. So if you have any questions, please feel free to reach out to our team. We can help you locate it. Once that form is completed, you will then log into your Empower account and you can upload that housing allowance form directly through your account. It will go to Empower. They will begin the processing. Then it will be sent to our team at CBB to review and make sure there's no questions that we have for you. And then we will move it forward for processing. Typically, it takes about 2 to 5 business days, depending on the request and when you submit it. If it's around a holiday, it may take a little bit longer, but we really work quickly to make these easily accessible for you. So if you have any questions, please don't hesitate to reach out to our team.
Thanks, Jenny. And now we're going to open it up for questions.
Excellent. Thank you, Amy. Before we open up for questions, I just wanted to say thank you to Amy. She takes the complex and she makes it understandable for us. So we're so grateful, Amy, that you're with us for this webinar and also for our financial wellness education events. I just wanted to drop that FWE that's going to be in Louisville back into the chat in case you're interested. You just have to get there and bring your spouse, and we cover your housing, your meals, and you get this wonderful time to take a deeper dive into these great benefits like the housing allowance while you're employed and in retirement. And you get to visit with Amy, our representatives from the Empower. It's a great experience. So if you're interested in Louisville, please remember that the last day to register is March 9th. Thank you all for joining us today. At this point, we are going to end the recording and we're going to open it up to Q&A time.
Yes. So
All right.
yep. Go ahead.